Your roadmap to the latest in auto. Welcome to Highway Herald. The EV revolution is hitting some major speed bumps. Not too long ago, we all thought Chinese EV makers were set to dominate the market with their cutting-edge technology and unbeatable prices. But hold on to your gear shifts, because the Chinese EV market is facing some serious challenges. Today, we're diving into the 6 signs pointing to the potential collapse of the Chinese EV market. Buckle up, gearheads. It's going to be an intriguing ride. Sign number 6, the intensifying price war. As we've mentioned, car makers planned for continued market growth over the past few years. Now, with a significant shift in demand, they're finding themselves in a tight spot. While demand has cooled, production levels are higher than ever. With nearly 100 EV makers in China, standing out in this crowded market is challenging, leaving price cuts as one of the few viable strategies. Initially, lowering prices might seem like a smart move. On average, Chinese EVs are now 30% cheaper than just a few months ago. However, these discounts have sparked unrest among early buyers who feel betrayed by the sudden price drops. Some cuts exceed $5,000, leaving those who recently bought EVs feeling cheated. This has led to small-scale protests against the price changes. As a result, many potential buyers are now hesitant, fearing they might face similar regret if prices drop further after their purchase. This uncertainty is keeping them away from the market, further complicating the situation for EV makers. Sign number 5. Slowing growth in the domestic market. In North America and other Western markets, a common thread emerges. Growth has plateaued. This trend extends to China, where after years of robust expansion, the growth rate has noticeably tapered off. In 2022, the year-over-year change was an impressive 96%. By 2023, it had plummeted to 33%, and this year shows signs of further deceleration. With a lackluster February and a cautious March, projections for this year suggest the market won't surpass 22% growth. While commendable in conventional terms, this falls short in the dynamic realm of EVs. EV makers had anticipated much more robust growth, shaping their business strategies accordingly. However, today, there seems to be a lack of enthusiasm among customers. The Chinese market, much like its global counterparts, is far from reaching its zenith, which inevitably affects the EV sector. Furthermore, the phase of early adopters has passed, prompting most Chinese consumers to opt for established ICE options for various practical reasons. This shift in consumer behavior signals the advent of a market collapse, heralding a fierce price war. Sign number 4, the onset of the knockout phase. With demand cooling and the market oversaturated, the next phase is inevitable. Nearly 100 EV makers exist in China, but most won't survive this crowded battlefield. The competition is fierce, and with the market no longer booming, supply far exceeds demand. This situation, combined with the brutal price war, spells trouble for many EV makers. Many companies rely heavily on government support and haven't figured out how to turn a profit. As prices continue to drop, these companies will struggle to stay afloat. Zhang Xiang, a visiting professor at Huanghai Science and Technology University, predicts that the overcrowded market will weed out most small-scale manufacturers. According to Alex Partners, a consulting firm, only 25 to 30 EV makers are expected to survive by the end of this decade. Currently, the top 10 EV makers dominate 80% of the market, while about a third of the companies don't even sell 500 vehicles per quarter. These smaller players are on the brink of collapse, and even some of the more robust startups have already declared bankruptcy. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore sign number 3, strategic alliances for survival. As previously mentioned, the market is currently oversaturated and is expected to remain so for the foreseeable future. Coupled with the prolonged price war, which shows no signs of abating, many companies face the grim prospect of closure in the coming years. In this era of financial uncertainty, these companies are left with 2 main options. The first is to seek new investors. However, given the current state of the Chinese economy and waning investor interest in the industry, securing fresh capital is proving to be increasingly challenging. As a result, small and medium-scale companies are left with no choice but to seek survival through collaboration and consolidation. Even the largest car makers are being compelled to explore such strategies. These partnerships often extend to include collaborations with smartphone manufacturers and similar entities. For instance, Geely recently announced a partnership with Meizu, a smartphone maker, resulting in the forthcoming Meizu Dream Car MX, their debut EV. Other smartphone companies, such as Huawei, have also entered the EV arena through partnerships, like the one with Chery Auto, culminating in the launch of the Luxeed S7, positioned as a competitor to the Tesla Model S. For both EV startups and established car makers, such collaborations provide a crucial infusion of fresh capital and are increasingly becoming the only viable pathway for survival. Sign number 2. Tesla's challenges in China. Even though Tesla isn't a Chinese EV maker, it employs thousands of Chinese workers and has been a key player in the market for years. As a global EV leader, it's a perfect mirror of the current state of the Chinese EV industry. And now, Tesla is struggling, just like its Chinese counterparts. Selling EVs has become increasingly difficult. Tesla, based in Austin, is the second largest EV seller in China. However, its dominance has waned. In the last quarter, Tesla sold around 300,000 vehicles in China. While that number might sound impressive, it represents a massive drop from the last quarter of 2023, when sales exceeded 400,000. This 43% decline means Tesla now holds only about 10% of the Chinese EV market, far behind the leader, BYD, which commands 33%. To stay competitive, Tesla had no choice but to join the ongoing price war. Their key models are now significantly cheaper. The Model 3, for instance, is nearly $6,000 less expensive, now priced at around $31,000. The Model Y has also dropped from over $40,000 to $35,700. These price cuts raise sustainability concerns. To offset the lower prices, Tesla is looking for ways to reduce expenses. One strategy includes workforce reductions as part of a global plan to lay off 14,000 employees, with half of these cuts expected to come from Chinese assembly lines. Sign number 1. Post-pandemic economic hurdles. The COVID-19 pandemic significantly impacted the Chinese economy, and recovery is still ongoing. However, this is just part of the picture. After decades of rapid growth, the Chinese economy has reached its peak, and things have been slowing down. The projected growth for this year is just 4%. Beyond the numbers, the Chinese economy faces several challenges. One major issue is the aging population. Additionally, the banking system has seen better days. The government is trying to inject liquidity into the banking system and boost spending, but these measures are far from ideal. The middle class is regressing, and this is most evident in the near collapse of the real estate market. The overall automotive market in China has also been struggling. While EVs are gaining popularity, the market is far from its peak in 2017, when 24 million new registrations were recorded. Last year, the number was just over 21 million. This reduced market size means less room for EV makers to thrive. When we combine these factors with the struggling Chinese economy and the challenges in foreign markets, it's clear that Chinese EV makers face a tough road ahead. We'll be closely watching to see how they navigate these turbulent times. Thanks for watching. Make sure to subscribe to Highway Herald to stay updated on the latest vehicle news and upcoming videos. See you next time.